What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Over the last couple of trading days, it looks like the market might be settling down. We haven't seen a whole lot of total movement. It's still been pretty volatile, especially when you compare it to 2019 movements, for instance. But despite the fact that it's been moving up and down, 2, 3, 4%, it's kind of looking like it's settling into a little bit of a range here. We have a lot of analysts who are calling for new highs, higher highs will reach new highs later this year, and a lot of analysts who say we're going to experience new lows. So which is it? Is all the new money that the Federal Reserve is creating in conjunction with the spending from the federal government, is that money all coming in and going to continue to pump asset prices up even in the midst of an economic crisis, a recession, or even a depression, causing what would be termed a crack-up boom? Or are we going to see a retest of the lows or even lower lows as some of the economic realities start to unfold even further over the next couple of weeks and couple of months? Will we see a sell-off in asset prices? Let's dive in. Just in case you haven't had time to watch the markets extremely closely over the past few days, let me give you a little bit of a recap on some of the things that I've been watching. The first one that I'd like to take a look at is gold. Now, gold has experienced a little bit of a rally over the past couple of weeks, especially off the lows from that initial shock when it was sold off. And now, year to date, gold is actually up 14%. Now, gold stocks, gold mining stocks, are up as well, and the GDX, that's the ETF that tracks the gold miners index, it's up about 3% year to date, so still not amazing, but it's definitely outperformed the overall market, which as of today, year to date, the S&P 500 is currently down just about 14%. The Russell 2000, which, as you know, those are the smaller companies, those are the ones that don't have international exposure like some of the large, like pretty much all the large cap companies do that make up the S&P 500. And so I like to use the Russell 2000 as a little bit of a better gauge how the American economy specifically is doing, because those companies are going to be more accurately representative of the small businesses and the average individual's economic and financial life. The Russell 2000, despite the rally over the last couple of weeks, is still down about 29% year to date. Now, because we spent the first month and a half of this year rallying despite all of the economic problems that were showing up around the world and the coronavirus issues starting to show up really severely in China, our markets continued to rally up until February 19th was the day that we hit the highs with the S&P 500. So if we look at the highs so far this year, picture is skewed a little even more in the direction of gold and gold miners versus the overall stock market. Now, we just looked at year to date, Russell 2000 was down about 29%. From the highs, it's down about 30%. Looking at the S&P 500, which is kind of the benchmark most people use for just a gauge of the overall stock market, we saw that year to date, it's down, the S&P 500 is down about 14%. From the highs, though, it is down about 18%. Now, keep in mind, for both of these indexes, the high was right around the middle of February. We had a steep sell-off, and then we've had a rally from the bottom. With gold and gold mining stocks, however, the picture is a lot better. Gold hit its high for this year yesterday, actually. And so we're only down a little over 0.5% from the high, which happened yesterday with GLD. That's an ETF that invests in gold. And then GDX, the gold mining stock ETF, they're down about 2% from the high, which again was yesterday. And so these have both made new highs within the last couple of days. We're not having to look back at before the collapse happened to see these new highs. Gold has already started to make new highs this year. Not all-time highs yet, because those are still in place from 2011, but they're new highs for this year, and that's opposed to the general stock market. Now, we can also look at some growth stocks like Amazon that have started to hit new highs as well, new all-time highs. And so taking a look at this background with what the average index is doing, the average stock in the index, and then growth stocks, and what gold is doing as a response to the monetary stimulus and the fiscal stimulus, here's the framework that I'm looking at for the next couple of weeks and couple of months, what it looks like the market is going to do to me. We've had a relief rally. We've had a little bit of a correction in this bear market. And so at this point, what it looks like to me is we'll retest the lows. If fundamentals are allowed to play out at all, if there's any ounce of a free market left, we should at least retest the lows. The reason for this is a lot of the economic data that we have is delayed, and it comes out after a few weeks or a few months. And so right now we're just at the beginning of the earnings season, where a lot of companies are going to start to come out and show how bad their companies have really been hit from this economic shutdown. We're also going to start to see the unemployment numbers continue to increase. And at the current pace, it'll only take us about, I think, a month or 2 months to hit the total level of unemployment that we had after 2 years of the Great Depression. And so it looks to me like we're going to have economic data that's going to surprise us to the downside. And if the markets are allowed to price that in at all, it looks like we should at least retest the lows. So I do think that short term, we will still see another drop in the stock market. Now, because of that, I think the fiscal and the monetary stimulus will continue to expand, will continue to increase. Just in case you're not aware, monetary policy refers to anything the Federal Reserve does. It's basically printing money. Fiscal policy refers to anything the government does, like Congress, the president. It usually relates to taxes, but in our case right now, like with the stimulus bill, it has to do with helicopter money and bailout money. And so we're seeing a coordination right now between monetary policy and fiscal policy, where the government is issuing a ton of new debt in order to spend more than they've ever spent before. And then that debt that they're issuing, they're not getting debt. They're not getting people loaning them money from pensions or individuals or other central banks around the world, like has usually happened throughout history. It's the Federal Reserve who's loaning that money to the government, and they're just printing it in order to do so. And so we're seeing a coordination where any dollar that the United States government wants to spend, they're getting it from the Federal Reserve, who's supposed to be an independent entity to try and protect some of that, put in some natural limitations on spending. That's not really happening anymore. There's some tight coordination. So the government pretty much has a blank check to spend as much money as they feel is necessary in order to rescue the economy. And we're seeing that be the main driver behind the price of gold increasing and the price of gold going up, because gold is really a play on the value of money and the value of the currency that it's being priced in. And so when we see a massive increase in the amount of money that's being created in order to try and stimulate an economy or bail out an economy, you're going to see that reflected in the price of gold, because the supply of gold doesn't go up, and usually the demand of gold does go up in times like this, which means that the dollars that are available in terms of gold increase. And so the value of gold is really not changing. It's just the value of the dollar that's declining. And so that's why we're seeing gold react the way it has, and I expect that to continue, because it doesn't look like the government's going to be able to pull back any of this spending, any of this rescuing, because the moment they start to do that, we'll start to see massive unemployment, massive amounts of mortgages not being able to get paid, massive amounts of rents not being able to be paid, banks starting to experience a lot of pressure from all of the missed payments. You're going to see businesses closing left and right, and so they're going to have to do more and more and more of what they're already doing. And so I expect a lot more money to be spent by the government, a lot more new money created and injected into the economy. Now, we have to pair all of that brand new money injection with the fact that we are also experiencing a real economic crisis. And we started to see some of the, everybody forgets, we started to see a lot of this unfold late 2019. That was one of the reasons why the repo market blew up. There are strains and tensions and stress in the financial system globally already. And so, yes, the coronavirus is a big deal, but the system was so fragile already, and it was already starting to experience cracks that were threatening to cause it to collapse. And so this was like a big straw. The last straw on the camel's back has just happened to be a really big straw. And so whenever you have a real economic crisis and recession or depression combined with an unrelenting money printer, new money being created and injected into the economy to try and, deal with the consequences of a real, depression or crash or recession, because the depression and the recession, those are trying to heal. Those are the cure for all the malinvestments. And so you, in a free market, you would allow those things to work themselves out in order to kind of like a fire burning through a forest, getting rid of all the kindling and all the tinder, getting rid of everything that all the dead wood. And if you don't do that, if you just continue to bail out the system and inject new money, you're just putting out all the fires. Eventually, you're letting all of that dangerous kindling build up. And then the forest fire, when it actually happens, will be too big to control and it'll burn everything down. And so that's what we're seeing right now. We're seeing that forest fire from, all of the bailouts, the policies of the last 20 years, really. We're seeing all that now start to be ineffective and the fire's too big to put out. And so the result of that is you have this contraction, this economic contraction, you have this wealth destruction, this recession, depression happening at the same time as all this monetary expansion. Then you start to see hyperinflation in what Ludwig von Mises calls the crack up boom. Now, I've mentioned crack up boom in earlier videos, but just in case you're not aware of what that is, that's basically the final stage of the collapse of a currency. Recent examples would be Zimbabwe or Venezuela. Older examples would be something like the Weimar Republic in Germany. If you're looking for a book that gives probably my favorite description of the events that took place in Germany that led to this hyperinflation, I would read Ray Dalio's book, Navigating Principles for Navigating Big Debt Crises. It's a large book, but there's 3 different sections, and in one of the sections he goes into a lot of detail on the Great Depression in America, the financial crisis in America, and then Weimar Republic in Germany, and the hyperinflation that resulted in that. So if you're looking for a really great resource on what happened and kind of the day-to-day documentation and how the policymakers dealt with it, I recommend that book. It was a really good account of that period of time. But that's essentially what a crack-up boom is. It's the final stage of the collapse of the currency, and it's associated with a real economic contraction, recession, depression, and they deal with that by just injecting more and more and more and more new money into an economy to try and deal with it, and it doesn't actually work. And once they start going down this path, it's almost impossible for politicians to pull that back and to remove that policy and to backtrack what they've done. They just have to continue doing more and more of this, the bailout money, the universal basic income, the stimulus checks, the bailouts. And every time they do it, it becomes less effective and requires more of it to happen in order to continue kicking the can down the road. And so usually these things take place within the course of a year or less. The crack-up boom stage is usually a very, very short amount of time considering what led up to it, which is usually, years or decades. And so when people are asking, hey, why aren't we seeing the market fall right now? I think we will see another market crash. I think we will see a retest of the lows from a couple weeks ago, or maybe even new lows. But I don't think that's the end game. And I've been talking about this since I started this channel last year, that the end game is not, the Dow going to zero. The end game is not the NASDAQ going to zero. The end game is I'm not willing to sell you my shares of Apple at any price because I'd rather own an ownership stake of a company than own dollars, which are worthless, no matter how many pieces of paper you give me. I'd rather own a loaf of bread than any number of paper dollars that you'd give me. I'd rather own an ounce of gold than any number of paper dollars that you'd give me. You see the point I'm making here? The end game is all prices skyrocket because the dollar becomes worthless. And so even if we don't see the markets retest new lows or retest the old lows from a couple weeks ago, that doesn't mean all is well. That doesn't mean we're off the hook and we're, on the gravy train out of this, really quick recession and depression here. That actually could be a very, very, very bad sign. That's an indication that the currency is failing. Because if in the next 1 month, 2 months, or 3 months, we see, the Russell 2000 at all-time highs, the S&P 500 at all-time highs, all that means is that the people who own those shares are not willing to sell them at any price. And you know earnings are not going to be up. You know the fundamentals aren't going to be justifying those higher prices. And you know that if what is currently happening is any indication, unemployment numbers are going to be skyrocketing. So we're going to have a massive amount of the population who is, unemployed. They can't pay their bills. They're relying on government handouts, the actual checks, in order to just survive. Meanwhile, you're going to see a small percent of the population who was able to hold on to their ownership stake in assets. They're going to be looking like they're getting fantastically rich. The only problem is that the prices of goods and services are going to be skyrocketing at the exact same time. We're already starting to see that happen. When you go to your grocery stores, you're seeing prices are already starting to go up. And as the demand increases and as the supply continues to be held down from the quarantines and the work from home orders, the stay at home orders, and the things being shut down, you're going to see farms start to, close their doors, go out of business. You're going to see shipping companies not be, the logistics. You're going to see supply chains continue to break down, specifically in the States. And that's going to cause the supply to decrease even more than it already is. Those are the ingredients for a crack-up boom. You've got real economic contraction and recession or depression. You've got a massive amount of money being printed and pumped into the economy to try and deal with it. And you've got asset prices and price of goods and services starting to go up. And then all of a sudden, it seems like all at once that everybody will realize prices are not stopping going up. I better spend all my money as fast as I can because I don't want to hold on to this cash. It's quickly becoming worthless. I better get my hands on anything that I can that's actually going to give me some sort of value rather than a piece of paper. So will the market fall again? Probably. I think so. If it does, it will be followed by massively expanded new measures to bail out the economy and inject more money to deal with the issue. And even if it doesn't, what we're already seeing is enough to cause a collapse in the confidence in the strength of our currency. What we're witnessing right now is the precursor to a tsunami. Right before a tsunami, you see the water recede from the beach. And the most dangerous thing you can do is go further and further out to access the waters, because all at once, you're going to see a massive wave come in from that tsunami. We're going to see a massive liquidity wave come in from all the dollars that are being printed. And we're going to see a very quick collapse in our currency, collapse in the confidence of our currency. And that will be the crack up boom. Thank you for watching. Let me know if you have any questions or thoughts in the comments section below. You guys are the best. You guys have a great day.